COMEX just dropped a silver bombshell, and Wall Street is panicking. Right now, in trading rooms across New York, London, and Hong Kong, phones are ringing that should not be ringing on a quiet afternoon, because something has just changed inside the world's most powerful metals exchange. Something that will alter the way silver moves. Forever. No more waiting for Monday. No more safety in the weekend silence. The old rules are gone. And by the time most investors understand what just happened, it may already be too late to prepare. Stay with us, because what comes next could reshape your entire strategy. Welcome back to Precious Metals Intelligence, the channel built for those who prefer to understand markets before the headlines catch up. If you are new here, we are glad you found us at exactly the right moment. Before we go further, we would love to know, where in the world are you watching from today? Drop your city or country below. It means a great deal to see how far this conversation reaches. For more than a century, the silver market followed one simple rule. It opened, it closed, and for 2 full days every week, it went quiet. Traders called this the weekend gap, and everyone in the industry learned to live with it. Prices would settle on Friday afternoon, and no matter what happened in the world after that, the market simply would not react until Monday morning. That rule just ended. COMEX, the exchange that sets the benchmark price for silver traded around the world, has announced that its 100-ounce silver futures will move to 24-hour, 7-day-a-week trading starting on September 11th, pending regulatory review. On the surface, this sounds like a small technical update. In reality, analysts say it marks one of the most significant structural shifts the silver market has seen in decades. To understand why, it helps to think about what the weekend used to protect traders from. War could break out on a Saturday. A currency could collapse on a Sunday. A central bank could make a surprise announcement while markets were closed. In the old system, none of that mattered until Monday. The market would simply catch up all at once, often with a violent price jump the moment trading resumed. That delay created a strange kind of false calm. Nothing seemed to be happening, even when everything was happening. Now, that false calm is disappearing. If a crisis erupts on a Saturday night, silver can move immediately. If a currency comes under pressure on a Sunday afternoon, the price can respond in real time. There is no more waiting. There is no more Monday surprise. The market becomes a living, breathing thing that never fully rests. This is not the first time COMEX has tested this idea. Back in July, the exchange quietly expanded its 1-ounce gold futures to the same 24/7 model. At the time, it looked like a modest experiment aimed at retail traders who wanted more flexibility. Few people outside the industry paid much attention. But the numbers that followed were hard to ignore. Since that gold launch, more than 53,000 contracts have traded during the newly created weekend sessions, representing over $200 million in notional value. According to CME Group, this became the largest liquidity pool ever recorded for weekend trading in gold futures. In other words, the experiment worked, and now the exchange is applying the same model to silver, a metal that behaves very differently from gold. Silver is not just a monetary asset watched by central banks and currency traders. It sits at the crossroads of two worlds. It is treated as a safe haven investment, similar to gold, but it is also a critical industrial material, used in solar panels, electric vehicles, electronics, and defense technology. That dual identity makes silver more sensitive to a wider range of news. It reacts to inflation reports and interest rate decisions, just like gold. But it also reacts to factory demand, supply shortages, and shifts in global manufacturing. Very few assets carry that kind of dual exposure. This is precisely why moving silver to a 24/7 trading model carries so much weight. A metal that already responds to more types of news than almost anything else in the market will now be able to respond to that news at any hour, on any day, without delay. The old buffer zone, the one that gave investors time to think before markets reacted, is being removed. Executives at CME Group have framed this decision around convenience. They point to strong demand from retail investors who want the ability to manage risk and act on opportunities whenever they choose, rather than being forced to wait for a trading floor to open. That explanation is reasonable on its own, but experienced market watchers tend to ask a different question. Exchanges do not usually expand access without expecting a wave of activity to fill that access. When a marketplace opens its doors wider, it is often because something is coming that requires more room. That question sets the stage for everything that follows. Because at almost the exact same moment COMEX made this announcement, one of the largest banks in the world was making a very different kind of statement about where silver prices might be headed next. And when those two developments are placed side by side, a much bigger picture begins to emerge. Markets rarely change their rules by accident. When something as fundamental as a trading schedule shifts, experienced observers know to look for what sits behind the decision. And in this case, 3 separate developments landed within days of each other, forming a pattern that is difficult to dismiss as random. The first piece is the COMEX announcement itself. The second piece came from Citi, one of the largest banks in the world. In a note sent to clients, Citi analysts reaffirmed a bullish outlook on silver, stating that the metal could climb toward $90 an ounce within the next 6 to 12 months. Their reasoning centered on a shift they see coming, where investment demand begins to outweigh the slower, steadier demand that comes from factories and manufacturers. Citi kept its short-term target at $75 for the coming 3 months, with the $90 figure representing the 6 to 12-month horizon. The third piece arrived almost immediately after. New data on producer inflation came in lower than expected. That single data point mattered more than it might appear because it reduced the likelihood of another interest rate increase from the Federal Reserve in September. Lower inflation pressure often means central banks feel less urgency to raise borrowing costs, and lower interest rate expectations tend to support the price of metals like silver and gold, which do not pay any interest themselves and become more attractive when the return on cash and bonds starts to shrink. On their own, each of these three events might be treated as routine news. An exchange updates its trading hours, a bank issues a price forecast, a government releases an economic report. These things happen every week. But when they arrive together, within the same short window of time, a different explanation becomes harder to ignore. Exchanges like COMEX do not build new infrastructure for a market that shows no signs of change. Expanding to 24-hour trading requires investment in technology, staffing, and regulatory coordination. It is not a decision made lightly or without internal data suggesting the demand will be there to justify it. When CME Group expanded gold trading in July, the results, more than 50,000 contracts and over $200 million in weekend volume, gave them clear evidence that traders wanted constant access. Silver, with its dual role as both a monetary asset and an industrial material, is arguably even more sensitive to the kind of unpredictable, round-the-clock news that this new trading model is designed to capture. This is where the idea of liquidity architecture becomes useful. Liquidity architecture refers to the way an exchange builds and shapes the pathways through which money moves in and out of a market. When an exchange redesigns that architecture, it is often responding to signals it sees before the general public does. Trading desks, institutional clients, and large funds often express their needs privately, through order flow, through requests, through the kind of quiet conversations that never make headlines. By the time an announcement like this becomes public, the groundwork has usually already been building for months. Seen through this lens, the timing of Citi's $90 forecast takes on new meaning. Citi is not a small research boutique. It is one of the most influential voices in global finance, and its price targets are read closely by institutional investors, pension funds, and family offices around the world. When a bank of that size reaffirms a bullish, multi-month price target at the exact moment an exchange is rebuilding the infrastructure around that very metal, the two events start to look less like coincidence and more like two sides of the same emerging story. Add to this the shifting outlook on interest rates, and a clearer picture begins to form. Lower rate expectations make silver more attractive to hold. A 24-hour trading window makes silver easier to buy, sell, and react to at any moment. And a major bank is now publicly stating that investment demand, not industrial demand, will be the primary force driving prices higher in the months ahead. None of these three developments by themselves would be considered dramatic. Together, they suggest that something larger is being prepared, quietly beneath the surface of ordinary financial news. The question now becomes how institutions and large funds are likely to respond, and what happens to a market's behavior once the traditional walls that once contained it are taken away entirely. Large financial institutions do not think about markets the way individual investors do. A retail trader might ask whether the price of silver will rise or fall next week. A hedge fund or a bank's trading desk asks a different question entirely. It asks how much risk it can safely hold at any given moment, and how quickly that risk can change while no one is watching. That second question is where the true significance of COMEX's decision begins to reveal itself. For decades, one of the biggest risks institutions had to manage was what traders call gap risk. Gap risk is the danger that something happens while a market is closed, and when trading resumes, the price has already moved sharply against a position with no opportunity to react in between. This is precisely what made weekends so dangerous for large funds holding metals positions. A geopolitical event on a Saturday, a surprise currency devaluation on a Sunday, or an unexpected diplomatic statement overnight could all sit untouched for nearly 48 hours. By the time Monday's opening bell arrived, the damage, or the opportunity, had already been priced in all at once, often through a violent opening move that individual traders had no chance to prepare for. Institutions built entire strategies around this reality. Position sizes were often kept smaller heading into a weekend, specifically to limit exposure to a gap that could not be managed in real time. Hedging strategies were adjusted on Friday afternoons, not because the underlying view on silver had changed, but because the risk of being unable to react for 2 days demanded caution. In many ways, the weekend closure quietly shaped how aggressively institutions were willing to invest in the metal at all. That constraint is now being removed. With 24-hour trading, a fund no longer has to sit helplessly through a weekend crisis. It can adjust its position the moment new information arrives, regardless of the day or the hour. This changes the calculation entirely. When the risk of being trapped disappears, institutions often become more willing to hold larger positions because they know they retain the ability to respond immediately if conditions shift. Analysts who study market structure describe this as a reduction in what is sometimes called the risk premium of illiquidity, the extra caution investors build into their decisions simply because they cannot act whenever they choose. This shift becomes especially relevant when placed alongside current geopolitical tension, particularly around the Strait of Hormuz. This narrow waterway remains one of the most closely watched flashpoints in global energy and security discussions, and any escalation or resolution there tends to ripple through commodity markets, including silver. Under the old trading schedule, a weekend development in that region might have gone unpriced until Monday. Under the new 24-hour model, the market can absorb that information the moment it happens, rather than storing it up for a delayed and often chaotic reaction days later. Citi's own research has pointed to this dynamic directly, suggesting that silver could track gold's movements closely if tensions in the region begin to ease, describing silver as a high beta play, meaning it tends to move with greater intensity than gold in either direction. A metal with that kind of sensitivity benefits enormously from a trading structure that allows it to react in real time, rather than waiting for a delayed and exaggerated adjustment once markets reopen. This is the institutional playbook now taking shape. Removing the weekend gap does not simply add convenience. It fundamentally changes how much risk large investors are willing to carry, how they hedge that risk, and how quickly capital can move in response to global events. For decades, silver's price action was partly a story about timing, about which events happened to land during trading hours, and which ones were left waiting in the dark. That story is now being rewritten. As this new structure settles into place, the focus naturally shifts toward the physical side of the market. Trading hours and institutional behavior tell only part of the story. Beneath the surface of prices and futures, contracts lies a separate and equally important question, one tied to actual supply, actual demand, and a metal that is quietly becoming harder to find in the quantities the world now requires. While trading desks and institutions adjust to a market that never closes, a separate story has been building far from any exchange floor. This story is not about contracts, screens, or trading hours. It is about physical silver itself, the actual metal moving, or in some cases not moving, across borders. India offers one of the clearest examples. India has long been one of the largest buyers of silver in the world, driven by jewelry, industry, and investment demand from a population that has trusted precious metals for generations. Recent data shows that India's silver imports have fallen sharply, by more than 90% in a single month. At first glance, this might look like a sign of weakening demand, but analysts who follow the region closely describe a different explanation. India appears to be intentionally limiting silver imports, not because its citizens want less silver, but because the country is trying to protect its currency, the rupee. Importing large amounts of silver requires spending foreign currency, and in times of currency pressure, governments sometimes slow that spending down on purpose. This creates an unusual situation. Demand inside India has not disappeared. It has been held back, artificially, by policy rather than by choice. Citi's research notes that this suppressed demand is showing up in another way, through a domestic premium of roughly 7%, meaning buyers inside India are paying more for silver than the global price would normally suggest. That premium tends to grow heading into the final months of the year, a period tied to festivals and wedding season, when silver buying traditionally increases. Analysts expect that pressure to intensify rather than fade. At the same time, a different kind of demand has been building on the industrial side. Silver plays a critical role in solar panel production, electric vehicles, and next-generation electronics. Even as certain manufacturing techniques attempt to use less silver per unit through a process known as thrifting, and as newer solar technologies adjust their material requirements, the overall volume of demand tied to these industries continues to climb. Artificial intelligence infrastructure, expanding 5G networks, and the ongoing global shift toward electric transportation all rely on silver in ways that are difficult to replace with any other material. Citi's research points to something significant in this context. The bank expects the global silver market to remain in deficit through 2027. A deficit means the world is consuming more silver each year than is being mined and recycled combined. This is not a new phenomenon in the silver market, but the scale and duration of the current deficit stand out. Supply cannot be increased quickly. Mining new silver requires years of exploration, permitting, and development. Unlike a factory that can add a second shift to increase output, a silver mine cannot simply produce more tomorrow because prices rose today. This is where the physical story and the trading story begin to intersect. A market that now trades 24 hours a day is layered directly on top of a metal that is already running in short supply. Every new piece of demand, whether from Indian households once import restrictions ease, from solar and EV manufacturers, or from investors following Citi's bullish forecast, is arriving at a moment when the available above-ground supply is already stretched thin. Historically, tight supply situations took time to become visible. Reporting delays, trading hours, and slow-moving inventory data all created a lag between reality and price. That lag is now shrinking. A market open at all hours reacts faster to every new data point, every shipment, every shift in premium. The gap between what is happening in the physical world and what is reflected in the price is closing. Two forces are now moving in the same direction at the same time: a structurally tightening supply picture and a trading system built to respond to that tightness without delay. What happens when those two forces fully converge is the question that now demands the closest attention.